Alright, what is up everyone? Welcome back to yet another video. My name is Darren from Chart Nexus, and today I'm going to be sharing with you the secrets of the RSI. Now the RSI is a very common indicator used by many traders in the market. Typically it's known as the RSI, but the full name is the Relative Strength Index. So today I'm going to be sharing with you exactly what is the RSI, what it tells you, and how you can use it to improve your trading. Alright, so let's get into it. So first off, let's learn about what is the RSI. So an RSI is basically a momentum indicator that measures the speed of recent price changes. So what this means is that if you see the RSI starts to point upwards and starts to trend upwards, it is telling you that the momentum of the price is upwards, meaning that the price is increasing and increasing. And if you see that the RSI indicator is pointing downwards and moving down, it's telling you that the momentum is on the bearish side, meaning the price is likely to continue to go down. And a common way that traders like to use the RSI is to help them identify if the stock price is overbought or oversold. So what this means is that if the RSI is telling you the price of a stock is currently overbought, what this means is that the price has been increasing a certain amount in a short period of time that the market deems that it is likely to reverse soon. And the same can be said about oversold levels, where it is basically a level where the market feels that it has been selling so much in a short period of time that it is likely to rebound to the upward soon. And you have to remember that in the market, a stock doesn't always go up forever. It goes up, it comes back down, goes up, comes back down, goes up, comes back down. So when does the market feel like it is at a level where it needs to pull back or come back down before continuing its prevailing trend? So that's what the RSI basically tells you, which is if a stock is at a price where it is likely to reverse in the opposite direction soon. Okay, so next let's talk about how to use the RSI. So typically, an RSI, if the RSI crosses above the 70% line, it is telling you that the stock price is in the overbought region, which means that the price is very likely to reverse or do a pullback soon. And if the RSI crosses below the 30% line, it is telling you that the stock price is now oversold, meaning that the price is very likely to rebound soon into the opposite direction, which is up. Now, another thing to remember about RSI is that it's not always the case that the stock, goes up, and the RSI has to cross above 70 before pulling back. And it's also the same for if the stock is going down. It does not necessarily have to. The RSI does not necessarily have to cross below 30 before the stock can reverse upwards. I'm going to tell you what about cases that this will happen, which is in trends. So if a stock is in a very strong uptrend, the RSI is likely to always stay above the 30% line, which means that even if the stock has made a high and pulls back to make a higher low, the RSI does not necessarily cross below the 30% line before the stock reverses back into its original trend, right? And the same can be said for when a stock is in a downtrend. When a stock is going from a lower low to a lower high, the RSI is unlikely to go above the 70% line before the stock continues back down into its original trend. So let's look at some chart examples to illustrate how to use the RSI to your trading. All right. So here we have Emulus with us, and to pull up the RSI, we just have to go to the left panel here under indicators and scroll down, and you'll see RSI. Now typically the RSI uses a 14 period, and you can change to any other period if you want, but generally it doesn't make much difference. So we just use the 14 period, the default setting. Now as you can see, it has already been plotted a horizontal line that signifies that this is the 70% line and this is the 30% line. which means that if the RSI crosses above 70 into this region, it's telling you the stock price is now overbought. And if the RSI crosses below the 30% line and is in this region, it's telling you the stock price is oversold. All right, that's just the basic interpretation that a lot of traders use the RSI to tell them. Now, remember what I said about when a stock is in oversold region, it is very likely to reverse upwards, and when the RSI is in the overbought region, it is very likely to reverse down. Now we can see just from right here, you can see when the price rallies strongly up to this point, and the RSI has crossed above 70 into the overbought region. What happens next? We see that the stock starts to pull back and comes down, right? And when the stock has come down, has been selling and decreasing, up to a certain point, you can see the RSI has now crossed below the 30% line, which is telling you that the stock price, after making such a high and selling back down, it is now considered to be oversold, and is deemed to be a good deal right now. So the stock is very likely to reverse upwards soon, and we can see that the stock does slowly reverse upwards. Now, do keep in mind that the RSI is not always the case that if a stock has sold off and the RSI crosses below 30, that is going to reverse into the opposite direction. Because in a strong trend, and the stock has a huge momentum behind it, and for example, if it's selling down and has very strong momentum pushing the stock price down, the RSI can stay in the oversold region for extended period of time. Okay, so it does not necessarily mean that when the RSI crosses below 30 and it's going to reverse, and when the RSI crosses above 70, it's going to reverse down. So there are many cases that traders like to use this as their buy and sell signal, which is very wrong, and it will actually give you a lot of false signals in the market. So like any indicator, it should be used along with other technical analysis that you have done, and indicators, like most indicators, should only act as more of a confirmation tool. All right, so don't just solely use one indicator to give you signals whether or not to buy or to sell. Right, so this is something to keep in mind now. So let's look at a trending stock, because I want to illustrate to you guys what I meant by if a stock is in a strong uptrend, the RSI tends to stay above 30. Right, so it doesn't have to cross below 30 before the stock reverses up again. Now we can see here we have DNO, and DNO was in a very, very solid uptrend in this period. Now if we zoom in, we can see that during this uptrend period, the RSI does not cross below 30. And interestingly, you can see that the RSI, whenever the stock pulls back down and the RSI decreases also, it tends to bounce around the 50% line in an uptrend. And no matter how big the pullback is, how much the momentum was behind the stock selling off, the RSI does not cross below 30 before it resumes its original direction. Okay, so this is something to take note. That's just something to take note of when you see a stock in a very solid uptrend, that you don't wait for RSI to cross below 30 before deciding to buy on the reversal. All right, so now we have an uptrend example. Let's look at a downtrend example. So let's go to glove counters. Sadly to say that glove counters had a bullish run last year, but in the past few months it has been on a solid downtrend. So it's the best example we can use. So here we have Supermax, and we can see that the trend, after making a high here, has been on a very solid downtrend. And notice on the RSI that whenever the stock is making lower lows to lower high, lower lows to low high, the RSI does not cross above 70. In fact, it tends to be rejected around the 50% line. As you can see, goes down, comes back up here, the RSI goes to the 50% line, gets rejected, and the stock continues back down into its original direction. So this is an example of how in a solid downtrend, the RSI will not cross above, it's not will not, but it's rare that the RSI will cross above 70 before the stock reverses back down again. All right, so that's something to take note of. So another way that RSI can be used is to identify reversals, right? So aside from just using overbought and oversold levels to potentially identify reversals, another way that the RSI can be used is by identifying divergence. So what is a divergence? A divergence is basically when a stock, and you see that the price of a stock is making higher highs in an uptrend, but you notice that the RSI is making lower highs, which means that the momentum that was pushing the stock higher is not as strong as anymore. In fact, it's telling you that the momentum is decreasing. Okay, now another example for bullish divergence is when the price is making lower lows in a downtrend, but you notice that the RSI is making higher lows, which means that the RSI is telling you that the bearish momentum that is pushing the stock down is not as strong anymore, hence forming a divergence, meaning that the price is not moving the same way as the RSI. And preferably, we want to identify a divergence in oversold and overbought areas. So this will increase the likelihood of a potential reversal to successfully happen. All right, so let's look at some examples of where we can identify reversals and how we can use it to, how we can use divergence to identify reversals. All right, so let's go back to the charts. So here we have rubber X, and I want to just point out to you a very, very interesting point where we can actually notice divergence between the price and the RSI before a reversal happens. So I want to point out these two highs. Stock was in an uptrend, right? So it's making higher highs, higher lows, higher high, higher lows. Notice that the stock, when making this high compared to this high, is making a higher high. But interestingly, the RSI is making a lower high, which is telling you what? A divergence, meaning that the price is doing this, but the RSI is doing the opposite. Hence, divergence. And as you can see, the stock, after reaching this peak, reverses strongly into a downtrend. So that's just one of the ways of what I mean by a divergence. So now we have a bearish divergence. Let's look at a bullish divergence. So let's go back to DNO. So here we have DNO, and I want you to notice the price when it was on a downtrend. And I want to point out two interesting points, which is this low compared to this low. Now this low compared to this low is a lower low, right? But notice correspondingly on the RSI is making a higher low, which means that the stock price is not moving in accordance to the RSI, hence a divergence. And as you can see, the divergence occurred in the oversold region, or in this case, quite near the oversold region, and this will increase the chances of an actual reversal happening soon. And as you can see from the chart, the stock did reverse from a downtrend back into a uptrend. All right, so this is basically the example of a bullish divergence. All right, and bearish divergence is basically when the stock is making higher highs and the RSI is making lower highs, as we just saw at the other example of rubber X. All right, so there you have it. That is basically the RSI indicator and what it can tell you about the stock price and everything. It's a fairly simple indicator, and it's commonly used by many traders because it's very simple to understand and it's very simple to tell you what is happening with the stock price. All right, so as always, if you like the video, please do give us a thumbs up and subscribe to the channel for more. Of course. And if you have any questions that you are not sure about the RSI or anything you'd like to ask, just leave it in the comments below and we'll get back to you. All right, so that's basically concluding our video for today. So my name is Darren from our Chart Nexus, and I will see you soon.